For decades, the 20% down payment has been treated as the golden rule of home buying. It was the threshold that proved you were financially ready to own a home. But as we navigate the real estate market of 2026, many buyers, especially first-timers, are wondering, does it really matter anymore? The short answer is no, you don't need 20% to buy a home. But the decision to go lower comes with specific trade-offs that could affect your wealth for years. While the median down payment in 2026 is actually closer to 12.8%, and many successful buyers are getting in with as little as 3% or even 0% down, there are still undeniable financial perks to hitting that 20% mark. In this guide, we'll break down the nuances of the 20% rule, so you can decide which strategy fits your family's goals. Historically, lenders required a 20% down payment to ensure that if the homeowner defaulted, the bank could recover its investment. If you put down less than 20%, you were seen as a higher risk. To mitigate that risk, lenders began requiring private mortgage insurance, PMI. Today, the 20% rule is more of a financial benchmark than a hard requirement. We have specialized programs, like the FHA loans or the Chenoa Fund, that allow for significantly less. However, the 20% mark remains the magic number for eliminating extra monthly fees and securing the most aggressive interest rates. If you have the cash sitting in a high-yield savings account or an investment portfolio, putting 20% down offers three major advantages in the 2026 market. On a conventional loan, 20% down usually eliminates the need for PMI. This can save you anywhere from $200 to $400 per month, depending on your credit score and the home price. Over 5 years, that's up to $24,000 staying in your pocket instead of going to an insurance company. Lenders in 2026 are highly sensitive to loan-to-value, LTV ratios. When you put 20% or 25% down, you are classified as a low-risk borrower. This often results in a rate that is 0.25% to 0.5% lower than someone putting down 3.5%. On a $500,000 mortgage, that 0.5% difference can save you tens of thousands of dollars over the life of the loan. When Mona Botros, our realtor and office manager, presents an offer to a seller, a 20% down payment signals financial strength. Sellers often prefer high down payment offers because they are less likely to fall through during the appraisal or final underwriting stages. It gives you a negotiation edge that a lower down payment simply can't match. While 20% sounds great on paper, it isn't always the right move for everyone. Here is why many of our clients at Maya Team Inc. choose a lower down payment. The cost of waiting is a real factor. If you wait 3 years to save an extra $50,000 to reach that 20% mark, you might find that home prices have risen by $60,000 in that same time frame. By getting in now with 3.5% or 5% down, you start building equity and benefiting from home price appreciation immediately. In 2026, cash is king. If putting 20% down leaves you with $0 in your emergency fund, you are putting yourself at risk. It is often better to put 5% down and keep the remaining 15% as a safety net, or to fund home improvements that will increase the property value even further. If you put $15,000 down on a $500,000 home, 3%, and the home value goes up 5% in 1 year, $25,000, you have essentially doubled your initial investment. That's a massive return on your cash compared to the percentage return you'd see if you had tied up $100,000, 20%, in the same property. MLO, Mortgage Loan Originator. This is Ronnie Velasquez's primary role. An MLO works with you to find the specific loan product that fits your financial profile. DTI, Debt to Income Ratio. The percentage of your monthly income that goes toward paying debts. A higher down payment lowers your monthly mortgage, which improves your DTI. A FICO score, your credit score. If your FICO is lower, a larger down payment can help offset the risk and secure a better loan approval. Underwriting. The process where the lender verifies your income, assets, and debt to give the final clear to close. Use this quick checklist to evaluate your current situation. Do you have an emergency fund? At least 3 to 6 months of expenses. If 20% down wipes this out, go lower. How long do you plan to stay? If it's less than 5 years, the cost of PMI might be less than the cost of tying up all your cash. Go lower. Is your debt to income DTI high? If you have high car payments or student loans, a 20% down payment will lower your monthly mortgage and help you qualify. Go higher. Are you a first-time buyer? You may qualify for 0% down programs that make home ownership possible years earlier than expected. Go lower. Deciding on a down payment isn't just about a single number, it's about your entire financial future. At Maya Team Inc., we take a consultative approach. We don't just sell you a house, we help you engineer a financial win. Ronnie Velasquez, our real estate and mortgage broker, realtor, ER, and mortgage loan originator, MLO, can run a side-by-side comparison for you. This report shows you exactly how a 3.5%, 10%, and 20% down payment would look over the next 5, 10, and 30 years. Meanwhile, Mona Batros, our realtor or an office manager, ensures that whichever path you choose, your offer is structured to win in today's competitive market. Don't guess when it comes to your largest investment. Let's look at the data together and find the perfect balance between monthly savings and cash on hand. Visit our community for tools and calculators, nas.io MyATM Inc. Call, text us directly. Email us. Follow us on social media for daily market updates and tips on how to win in the 2026 real estate market.